Hey there, awesome accounting student. Mark Franke here, and this video is the overview of Chapter 2, all about the accounting process and the accounting equation, and we're going to use problem 2-2B today to illustrate the concepts. So, let's get started. The accounting equation, as I have explained in my orientation, was developed by a man named Luca Pacioli back in the 15th century. In fact, just a little known fact, he trained accountants in Italy, and when Ferdinand and Isabella sent Christopher Columbus across the ocean to discover the New World, they insisted that a Luca Pacioli trained accountant be on board one of the three ships that went, the Nina, the Pinta, and the Santa Maria, and to keep track of the inventory and that stuff. So anyway, this formula stood the test of time for over 500 years, and it's not going to change anytime soon. So its derivative, or the starting point, was assets minus liabilities equals equity. That is an algebraic equation because it has an equal sign, which means we have to keep things equal on each side. But because assets minus liabilities equals equity, we have this negative liabilities thing that's harder to deal with. Math, algebraic rules say we can move liabilities over to the other side of the equal sign if we change the sign. So it became assets equals liabilities plus equity, and that is the formula that we use. But again, it was derived from assets minus liabilities equal equity. So what are assets? Assets are things that are owned that have value. Things meaning tangible personal property. That's an asset, something that you own that has value in the future. The reason that we have it is because we'll get benefit in the future from that asset. If we've already gotten the benefit in the past, that's an expense. And we'll see how that works. But if you just keep in mind that there's two criteria for an asset, it's things you have to own it, and it has to have value. Liabilities is money that you owe to third parties. Now, the criteria here is that we can express it in monetary terms. So in other words, a liability has to be something we can put a number on. We know we owe this amount of money. So when we take assets and we subtract liabilities, we get equity, which has basically four components in equity. But the definition of equity is assets minus liabilities. There's no other definition for equity. If you own an apartment building in Bellflower that's worth $1 million and you owe $600,000 on that apartment building, you have equity of $400,000. If somebody came to you and say, hey, show me the equity in your apartment building, you couldn't do that. What you could do is say, well, here's my asset, it's worth $1 million, and here's my liabilities, I owe $600,000, so equity is the difference. So this concept of equity is just the difference between assets and liabilities. But as we go through and record transactions, we're going to use this equity area or category for the other side of basically every one of our transactions. So we split the equity into two components: the piece that relates to the owner and the piece that relates to the operations. So the owner of a company is the special person who puts money in and takes money out as needed. So we keep track of that in separate categories. And then the operations relate to What do we do in our business? How do we generate revenue? Providing goods or services to our customers. Most of what we're going to focus on, at least for the first 6 chapters in this class, will be on service businesses where they mow lawns or cut hair or do whatever they do to generate revenue, which makes equity go up. And then they incur expenses. They pay rent, they pay phone bills, they pay salaries, if they have employees, or any other expenses, and that makes equity go down. So there's the 2 things in the owner. Capital goes up when owners put money in, and drawings make equity go down when the owner pulls money out. Revenue, when we do perform services, we have to have done the work. That's important. Revenue makes equity go up, and expenses make equity go down. So that's the way this works. And if we start with something that is in balance, then we just keep adding things to it to make it in balance. So every time we do something, we're going to have 2 different categories that we have to deal with in order for this equation to stay in balance. Okay. So let's use problem 2-2B as an example. And I've set up a work paper here that looks like this so that we can do this problem. This is problem 2-2B, and as you know from my work paper video, if you haven't watched that, you need to. I want the name, your name, and the problem number at the top of each page. And this is going to be Alexander's Consulting Company. Okay, we always want to at least have the company name in the heading, and usually we have the date and the name of the schedule or whatever it is. But we're just starting out, taking baby steps, so that's good. So if you want to stop the video and set this work paper up, you could turn your paper sideways, or you could tape 2 pieces of paper together if you need to be it wide, or however you want to do it. Set it up, and then stop the video or pause the video, and then come back when you're ready. Okay, so we're ready to get started. The first thing we need to do is put in the beginning balances. So we have $152,000 in cash, $48,000 in accounts receivable, $51,200 in supplies, and $96,000 in equipment. These are the balances that were carried forward from last year or last period or whatever it is. And so then liabilities is $40,000. Capital is $199,200. Revenue is $208,000. And expenses, and I always put expenses in as a negative amount. So if I add together things on the left side and things on the right side, I'm going to get the same number. If you want to test it, stop the video and test it, you should. You can try it, but it does balance. So now we're going to go through the transactions. And by the way, these beginning balances were given to you in the book on page 49. Problem 2-2B. And then we're going to go through the transactions. It says that they performed services for $32,000 on credit. So anytime we do services on credit, it means we didn't get paid, which means our customers owe us. And when they owe us, it goes into accounts receivable because we're going to receive it at some point in the future. So we're on opposite sides of the equal sign. This gray bar in the middle is where the equal sign is. So we have to keep these things balanced. And so we're adding $32,000 on the left side under the category of accounts receivable, and we're adding $32,000 on the right side under the category of revenue because we performed services. Transaction B says paid $11,520 in cash for utilities. So we have some utilities expense over here, and we're going to put that under the description. And it says we paid it, so cash is going down. So we have a negative under cash, and we have a negative in expenses. I show negative expenses as negative because they are negative. Now, the book may do this as positive and then subtract it at the end. I think it's easier just to show them as negative as you go. But either way, these are on opposite sides of the equal sign. They have to be the same. That means that one side has to be negative, the other side has to be negative. Transaction C says we perform services for $40,000 in cash. So our cash account is going up 40 grand, and we're going to record $40,000 in revenue. Opposite sides of the equal sign, they have to be the same. 40,000 is going up in cash, and 40,000 is going up in revenue. Transaction D says paid $6,400 in cash for office cleaning services. So we've got 6,400 negative in cash, and we have 6,400 in cleaning expense, or office cleaning, however you want to describe it. Opposite sides, they have to be the same. These are both negative because cash is going down and we're recording an expense, which is always going to be negative. Transaction E says sent a check for $19,200 to a creditor. So we wrote a check for $19,200. Cash is going down, and where did it go? It went to accounts payable. We're paying off some of that $40,000 that was there at the beginning. Opposite sides of the equal sign, they have to be the same. They're both negative. Cash is going down, and accounts payable is going down because we paid it. On the top of the next page, paid $76.80 in cash for the phone bill. $76.80 is negative. We wrote a check. Oops. And we're going to record telephone expense. Cash going down, and an expense is going, making equity go down because it's negative. Transaction G, issued checks for $56,000 to pay salaries. Cash is going down. We wrote checks to our employees, $56,000, and so we're going to record salaries for $56,000. Transaction H, perform services for $44,800 in cash. Cash is going up, $44,800, and we're going to record revenue, $44,800. By the way, I apologize. My neighbor decided to mow his lawn right after I started making this video, so we'll just work through it. Transaction I, purchased additional supplies for $8,000 on credit. We're not paying for these supplies right now. We're going to pay later. So $8,000 in supplies. Supplies is going up, and accounts payable is going up. We're going to pay this in the future. That's a liability, paid in the future. And then the last transaction, which is number 10, and it's J, received $24,000 from credit clients, which means cash is going up and accounts receivable is going down. Okay, so if you stop the video, I'm going to total up each column, and you can do this on your own, and then you can start the video again when you've got the total, see if you can get it to balance out. I will be right back. Okay, I'm back, and I realized that I made a mistake on the second transaction. It shouldn't be 11,500. It should be 11,520. So I'm going to change that. But you should get the numbers that I've got there until we change it. And so I'm going to change it, and I apologize. And so our totals should be 160,000 in cash, 56,000 in accounts receivable, 59,200 in supplies. Equipment is 96,000 on the asset side. So if I add these all together, all four assets, cash plus accounts receivable plus supplies plus equipment, I get a total of 371,200. That's on the left side. That's the asset side. And then we have 28,800 in accounts payable. The capital account has 199,200. Revenue is 324,800, and expenses are 181,600. So if I total those up in this blue box down below by taking accounts payable plus the capital plus the revenue minus the expenses, we get also 371,200. It balances. It has to balance. If it doesn't balance, we have an error somewhere, and we have to go try to fix it. So this is just an explanation of how these accounting columns work. I hope you were able to get these numbers to work. You could do this over again if you want, or you can work on problem 2-2A, which is exactly the same with different numbers. So that's all for this video. Thanks for watching. I'll see you again soon. Bye-bye.